The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. The construction slowdown is happening. How it's affecting our biggest building product suppliers.
No one's talking the market up.
And a Kiwi biotech company is on edge, awaiting approval for Medicare to keep covering the cost of its tests.
It is a significant component of our revenue that is A, from the United States, and B, from Medicare.
It's Tuesday the 6th of June and you're watching Markets with Madison. As the residential construction sector slows down, should you be wary of cyclical stocks linked to building and housing? Building supplies company Metro Performance Glass is warning further softening is on the way, in what could be the first construction bust since the GFC. Metro Performance Glass, also known as Metro Glass, is the country's largest glass processor. It imports sheets up to 5 metres long, then cut and treats it at one of its 6 facilities across New Zealand and Australia. Double glazed, triple glazed, safety glass, frosted, mirrored and decorative, Metro makes it all. What it doesn't make though is much profit. In the past 5 financial years, Metro Glass has been profitable twice. It just made a $10 million loss for the 2023 financial year after taking an impairment on the value of businesses it bought before it listed. It announced a restructure at the end of 2022 and is trying to cut costs every year. COVID has really gotten its way. After big supply chain disruptions, it's imported more glass to ensure it has stock on hand. A move many manufacturers made, but also a costly one. Its debt has increased to 3.3 times earnings. It wants to get that down to 1 times earnings. But the more immediate problem is a construction sector slowdown. With fewer people looking to build homes, there's likely to be less demand for windows and balustrades. So how is its chief executive, Simon Mander, preparing for it? Simon, good to see you. Thanks for coming in.
Sure, thanks.
Should we start with the bad news first, get it out of the way? A construction sector slowdown, it's underway, isn't it?
Yeah, definitely. It's definitely slowing down. We've seen probably a 10% year from last year, and we're expecting 15 to 20 by the end of this financial year. Yeah, there's certainly quietening down.
Anecdotally, what are you hearing from customers? Are they putting off orders?
No, we're just seeing a slowdown. You know, I think there's still disruption in the supply chain, and we talk a lot about that, but it is there. So projects are taking a lot longer to complete. And I think there's uncertainty, so people are just waiting to see what's going to happen. Election year, you know, is always a bit of an interesting one. People are waiting. Interest rates have been rising. If they stabilise, I think that will help.
What key measures do you watch to see if it's recovering or if it's worsening?
Well, we look at housing consents, we look at completion data to see that lag, and we are seeing that lag between consents being lodged and completions expanding. So things are taking longer to do, and we're seeing a widening gap between the number of consents and the number of completions. So that, to us, there's this thing that while consents are really high, you've got this ability of the industry to actually, you know, is it operating at capacity? You know, there's staff availability issues, there's just capacity in general.
Your construction sector slowdowns are certainly not new, but what is it about this one that may have you particularly worried, or is it just the same as all the others?
Well, I think there just hasn't been one for quite a while. That's the main thing. You know, if you think the last one was after the GFC, which is some time ago, so we've got a whole industry that's just used to it getting more and more and more, you know, so suddenly looking at a downturn is a different way that we all have to look at things.
Metro Glass has already made some preparations for it. You made some impairments on goodwill in the financial year just ended. Can you explain what that tangibly was? Because it looks like to me it was some sort of pre-IPO acquisitions that are still sort of plaguing you.
Well, they're before my time, right? So that was done before IPO, it was just when the business was bought by private equity. So it's just an accounting thing. It doesn't make any difference on cash or anything. So, you know, when we took an impairment a couple of years ago, so that reduces your headroom down. So you end up, you know, having to, every year we formally test that. We're sitting here now and looking at it and going, well, look, you know, what's happening out there in the future? No one's talking the market up. and we took a small impairment.
How important do you think confidence is when we're looking into a sort of downturn? Can we talk ourselves into one? Do you think about that happening?
Yeah, I do sort of think that people get very negative about things, and so people start waiting to see what's going to happen. I think that definitely happens. You know, what we focus on is thinking, you know, I think it was one of the great learnings from COVID was, you know, you've got to have a whole lot of scenarios of, you know, if this happened, what would we do? And so we've got a lot of plans sitting there. So if we start seeing things, you know, moving in a certain direction by a certain amount, we know what we're going to do. Yeah.
You mentioned COVID, supply chain problems. Are they still problems, and how has your inventory strategy changed?
You know, I think for us, what a lot of people don't quite realise in New Zealand is that all flat glass, so you know, this sort of glass here,
yeah, absolutely.
It's all imported, right? And so, you know, shipping has been really disrupted. You know, we heard about the ports in New Zealand, that was just one aspect of it. So as a result of these big issues with shipping, we're carrying about 50% more glass in our warehouses than we were a year ago. So, you know, and the value of that glass is about 20% higher as well. So there's been this massive growth in our inventory cost. So that's when we talk about supply chain, that's what is really impacting us. We're starting to see that unwind. So our reliability of shipping is becoming a lot better, so that means we can sort of have less inventory, and we're seeing a reduction in the cost of that landed inventory starting to flow through, which is really helpful.
I can imagine that would have been pretty costly. Your net debt is currently sitting at 60 mil, which is 3.3 times earnings. Yeah,
so that's what's, you know, the inventory is the real reason that, well, big component of the reason that our debt has grown in the last year. The other part of that was our growth in the business in Australia, our debtor book's grown, right? So what we see, you know, the cost of landed glass since pre-COVID has doubled, you know, and that's been pretty much driven by freight costs. Yeah.
Wow.
So, you know, and that's had an impact on our ability, on our margins, and our ability to pass those price increases through to the market. There's been a lag there.
So you have 50% more glass. It's at a higher value, but you need to sell it into a market that is slowing down. How does that add up?
Yeah, well, that's a challenge, right? Yeah, and so what we've been working on, you know, there's been a new entrant. I think it was the day I started at Metro, actually, it was announced that these guys were getting into glass.
I remember that announcement.
Yeah, and you know, that's had has had an impact on the market and on us. So what we've been busy doing since then has been working on shifting our customer mix, and I think we've done a very good job of that. Yeah, we're a smaller business than we were 3 years ago, but we're very well positioned for the future.
Yeah, look, on the numbers, looking at your past 5 financial years, you've only been profitable twice. And the biggest one of those was $8.5 million. This is net profit. It seems like you kind of can't catch a break, like you're just trying to come up for air every year. So how will you achieve more profitability going forward in a tougher market with more competition? Yeah,
I think, you know, you're looking at after impairments there, so that's a different thing as opposed to cash. So, you know, we're very confident about the growing profitability of the business. We're very well positioned. We're seeing our cost base has been, you know, we took about, you know, over 8 to 9 million out of our cost base annualised this year. We're seeing pricing recovering, our margins recovering. So we're seeing that growth and profitability. I think you also had, you know, the Australian business was definitely a drag. You know, when I started at Metro, that was just breaking even, and then very quickly it, you know, was continuing a downward trend. It bottomed out. It's now in a really good space.
I was about to say, look at it now.
Yeah, that's going well. Yeah.
But you're about to get rid of it, possibly.
Well, you know,
so why would you look to get rid of one of the only things that's going well?
You know, when I started at Metro, I had quite a few major shareholders telling me, Simon, you should just shut the doors and walk away. It was a pretty bad spot. My answer to that was, well, look, I'm new, I'm going to look at this business and I think we can fix it. And so that's what we've done. I've always said that when that business is running well and profitable, we'll look at what we do with it. And we're at that point now. It's got a really good future. It's really well positioned. The market has got really nice dynamic to it with building code changes, which will see the industry or the housing, adopt double glazing universally in the southeastern markets. So the future looks very bright for that business, and there's growth opportunities there that will require some capital in a couple of years' time. And so we've said, look, now's the right time to look at that business, and we're going through a process and we'll see where that leads.
What do you want to do with it? Do you think it's wise to keep it or to carve it off?
Well, it all comes down to value, doesn't it?
Do you not need both though? Because if you look at other construction competitors, say Fletcher Building for example, the construction industries lag in both countries. So when one's doing poorly, the other might be doing well. They sort of, they offset each other in a way. So are you not sort of needing to keep both?
Well, it comes down to, again, as to value, right? As to where the company is right at the moment. Yeah, we have debt. We have more debt than we'd like. Just after COVID hit, we were down at a point where we were very close to paying dividends again, and we've had a really tough couple of years. So we're in a different situation. So, we have this really good business in Australia. We don't think the market recognises the value in that business. If you look at our market cap and our share, which is a function of our share price. And so we think that there's a very high value in that business. So we'll see what comes through on that.
Your share price has sort of been sliding since about 2017, so sort of before you got there. What's your message to investors?
Yeah, it's a tough one, right? We're a quite tightly held company. We've got some significant shareholders who have been very loyal to us and supportive. And I think if you look at the big picture of the business, it's a good story. We have to deliver the results, and we were on track for doing that. Then this thing called COVID came along and has really hit us. But I'm very confident about where the business is going, how we've restructured the business and repositioned it, and we've got some good tailwinds that are coming. The building code changes in New Zealand are a very positive thing for us, and we're very well placed to maximise value out of that.
Thanks so much for your time, Simon.
You're welcome.
NZX-listed Pacific Edge is selling thousands of its bladder cancer tests in the United States, but it's dependent on Medicare covering the cost of them, and that's up in the air. I sat down with its chief executive when he was in Auckland recently to ask if this is a make or break moment for the business. Hi Peter, thanks for your time.
Hi Madison, great to have you here.
Okay, this Medicare situation, they either will or won't continue to cover and reimburse the cost of your bladder tests. What could either of those outcomes look like for your company?
I guess it was late July last year. We found what was a proposed local coverage determination from Novitas, which is the Medicare administrative contractor that manages our reimbursement for Medicare. They proposed an alternative way for us to receive coverage from Medicare in the United States. And the new way would actually have seen us as a business lose coverage under the new set of rules. And so since that time, we've been trying to understand what those rules are, how they affect us, and also through the open comment period negotiate with Novitas as to whether or not they've got it right. In the United States, this sort of thing happens all the time. They propose something, sometimes it's good, sometimes it's bad, sometimes it has unintended consequences, and sometimes it has the intended consequences. And so in our follow-up conversations with them and through our lawyers, through our lobbying partners, coalition partners, we have a pretty good understanding of the intent behind it, and that it was focused more on personalised genomic testing rather than oncology diagnostics, and consequently we believe it's more likely than not that they will listen to the comments that we submitted in September, and that at some point when they do finalise it that they will address those comments.
How much of your revenue in total relies on Medicare reimbursing payment of your tests?
Yeah, we don't disclose the specifics of that, but it is a significant component of our revenue that is A, from the United States, and B, from Medicare and Medicare Advantage plans specifically. And it would lower the reimbursement rates from both Medicare and Medicare Advantage as a consequence of this. But other payers, like our contract with Kaiser, would be unaffected by this.
Is this then make or break for Pacific Edge?
I probably wouldn't characterise it that way, because regardless of the proposal, there will be a path to recoverage, and the path to recoverage is always dependent on the quality of your clinical evidence. And so, we believe we've already met that standard, and as a consequence, we will continue to be paid by Medicare. But in the event of an unfavourable decision, there will be a path forward for us, and it will revolve around the generation of high quality clinical evidence and the submission of that to Novitas again for reconsideration of coverage. And that is one of the reasons why we continue to invest in a clinical program generating higher and higher clinical evidence, even though we already have coverage today.
Hypothetically though, if you don't get coverage from Medicare again, and there'll be a time before you can get coverage once again, what would Pacific Edge do in that time period? Do you have other areas for growth opportunities?
No, that would be our primary focus, would be to continue to generate the evidence for recoverage for our existing tests. That's our path forward.
On your test, what does volume look like at the moment? Are they proving pretty popular?
Absolutely. So, that's one of the things that has gone very, very well for us. I mean, the throughput has been up 37%. Globally, 39% in the United States, so year over year, that's pretty impressive growth. And then because we've also improved through the course of the year various elements related to market access, including our reimbursement rates, that we've actually saw a 71% improvement in operating revenue year over year.
I can imagine that something like processing efficiency in a lab is quite important too. How does it look on that front?
Everything we do is a kind of performance excellence. There's a continued focus on performance excellence, and what that means is that everything that we measure and everything that we do in the lab, we track and we optimize on various KPIs, and we and over time we look to improve every single one of those metrics. So there are more than 20 different metrics for performance in a lab, and we look at all of reducing the turnaround time, for example, increasing the throughput, reducing the head count required to run something, improving the walk away time by the use of robots, and all of those kinds of things we try to improve through performance excellence programs.
And you're hoping you can continue to do that?
We know we can continue to do that, and it's just a matter of focus and investment. Because if you think about the kind of volume that we're processing today, which is around 30,000 tests per year, and we're obviously expecting to grow substantially over the next 12 months, it's also still a fraction of the potential volume for a growth company like Pacific Edge. So when we look at the total addressable market, and that's something that will take quite some time to capture a significant percentage of, you're talking about 4.5 million testing opportunities that we're chasing. So there is not just room for efficiency gains. We're actually just going to have to improve volume throughput from other elements of scale as well.
Thanks so much for your time, Peter.
Welcome.
Now, I have no idea how it's June already, but apparently it is, and that means that it's annual shareholder meeting season. I'll keep an eye on what the execs and chair people have to say and let you know if anything decent is said. I'm also chatting to Mainfreight's Chief Executive, Don Braid, this week, and I know this is a stock that a lot of you love, so if you have any questions for him, send them my way. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.